I'm Simon Hartzell, and this is NAI Global's Diving into Commercial Real Estate.
Thank you for joining us for another episode of the NAI podcast. Today's sponsor is Apto, and we have the founder of Apto, Tanner McGraw, with us. Hi, Tanner. How you doing?
Doing well. How about yourself, Simon?
Great. Thank you. And for our audience, if you wouldn't mind, tell us a little bit about your background and the story of Apto and service you provide.
Yeah, happy to. I spent almost 10 years as a broker, kind of hunting deals, chasing deals, mostly on the investment sales side, but did a little bit of leasing along the way. Worked for a few different firms, some on one end of the spectrum from a technology standpoint, more advanced, some on the opposite end of the spectrum, very manual from a tech standpoint. And, did that for a period of time, and technology was always really the bottleneck in our business. At least we felt that was the case. And then our last big downturn, 2008 and 2009, I started looking to, as many brokerage teams do, how do we accelerate out of the downturn? How do we, focus on the business, improve its efficiencies, find new opportunities, and ultimately just close more deals? And that's what led to the company. But this was originally built for that business, and went to market with it a few years after the fact. After, we got good acceleration out of the technology, meaning the brokerage business itself grew quite a bit. That led to some interest and obviously an opportunity to talk about the technology and then ultimately just opportunity to commercialize. So went to market with Apto in 2012, really focused around brokers and the tools that they need. Scaled the company since then, and last couple of years have really doubled down on kind of the user experience, basically just the ease of use of the technology for, again, those brokers, those teams that are trying to find out who they should be talking to, how they should be talking to them, how the deal flow becomes more efficient, and ultimately just more deals closed and better relationships with your clients.
So overall, give the kind of layout or that value proposition for a commercial real estate agent or firm. What does Apto do for them?
Yeah, I think probably the best way to think about it is we're a modern, no-hassle, intelligent CRM. And what that means for us is we help you take the data that you have, kind of organize it in a meaningful way, and kind of prepare for the day. Obviously, with that kind of classic CRM notion, a lot of this is around finding and winning new business, whether that be with existing relationships or new relationships. And then once you've found that, that new landlord rep deal, investment sale deal, whatever the case may be, we've got a tool set to help you better execute and close that out. So all the way across is really about improving, the return on your time. So how many calls do I make, or how many deals am I working, and ultimately how do I make more money with less time?
Which I think is critical, especially in this fast-paced environment, and being organized, being efficient, beating out your competition. If you're not on a platform or system like Apto, you're probably going to end up being left behind. So I think it's important for our listeners, if they're interested to find out more, and they should be, if they're using something that's not efficient or something that's dated, then how do they get a hold of the folks over there at Apto?
Yeah, you could obviously go to our website, www.apto.com. There's plenty of resource there on what we do with better depth and contact information. And I would agree that, we still see a lot of people, almost half of the marketplace, that runs their business with Outlook and Excel. That point of view has changed dramatically in the last few years, meaning there's a big shift in brokers that are investing in technology to build that speed and efficiency and awareness in what's going on. So there's definitely this looming, don't get left behind, whether it's us or one of our competitors. People should be investigating technology for sure.
Great. Well, Tanner, I got one more question, which I'm curious to find out in your crystal ball. Where do you see the development, either through your organization or within the industry of the tech space going? And that's a very broad question.
Yeah, I think that there's, we talk a lot about some of the, for lack of a better term, like kind of sexy new technologies, driverless cars and AI and blockchain and all of that. And those will no doubt have an effect on our industry in a lot of ways, probably dramatic, but they're probably longer term impacts. I think for, our customer base, ultimately people that are transacting, the service providers, the brokers, those teams, there's a bit of a workflow revolution. It's not a disruption of the business, as some would suggest, meaning there's a dramatic change in how we work taking place. So lots of change in behavior and the technology that's behind it. So my suspicion is you'll start to see these workflows combined with the data solutions to make life easier. That'll be a big trend moving forward. Just trying to knock out the kind of the bottlenecks in the business today.
Interesting.
So, again, I think we're just going to continue to see this workflow become easier and easier, and, again, make it easier to make a dollar with the same amount of time.
Interesting. Well, again, appreciate the time. Thank you for being our sponsor, and thanks again, Tanner, for being on the call.
Yeah, our pleasure.
Welcome to another episode of NAI Global's Diving into Commercial Real Estate. Today's episode is Your Capital Gains Tax Options, Learning about Deferred Sales Trust. Today's guest is Brett Swarts with Capital Gains Tax Solutions. Let me give a little background on Brett. He's got a pretty impressive resume. Is the president of Capital Gains Solutions located in Sacramento, California. As a team of partners with the estate planning team, Brett provides trustee services which helps real estate and business owners win with their capital gains deferral, freedom, liquidation, diversification, so they can preserve wealth and grow their investment moving forward. Brett is licensed as a commercial real estate broker, or I should say broker, helping investment real estate owners buy, sell properties. Has been in business since 2006. He also holds the Series 22 and 63 licenses. With over $70 million in closed commercial real estate brokerage transactions, he was formerly associate of a large commercial real estate brokerage firm, one of the largest in the country. His hands-on training from being one of the best in the business, a award-winning professional, has successfully completed 1031 exchange transactions, has a vast knowledge and experience as he passes along this knowledge to his business owners and clientele. He's a trusted professional, has worked on many various different types of transactions, from multifamily, retail, medical office, mixed-use properties. Brett holds a BS degree from William Jessup University, distinguished himself with a academic and athletic scholarship, captain of the basketball team, and was given the most inspirational award and honorable mention at the CalPAC All-Conference team in 2006. He resides in Roseville, California with his wife Melanie and their 4 daughters. Welcome, Brett.
Thanks, Simon, for having me. It's my pleasure to be here.
And was there anything I was missing on your background? You've got a pretty extensive background there. Anything you want to share with our listeners about your background and how you've got
where you are today?
You've covered it pretty well. You know, commercial real estate, starting out in college, and was trained in how to underwrite properties and was licensed and began selling real estate right out of graduating, and it really is what led into this company, Capital Gains Tax Solutions, is the need for options for clients who have just capital gains tax deferral inability or illiquidity, if you will, with assets that are in commercial real estate particularly, but also primary homes and businesses. And so just the day-to-day conversation over the years became apparent that the need for more than just a 1031 was apparent, and that's what's brought us here today.
Yeah, let's jump right into that because it's very interesting. The buzz on the street is 1031 exchanges. There's pluses, minuses. It's in DC right now and being looked at and scrutinized. What is deferred sales trust? Tell us more about it.
Sure. And it's good to start with what the 1031 is, right, and what it's not, and then we can compare and contrast the deferred sales trust and why it might be advantageous to your listeners who are either brokers or investors in commercial real estate themselves. So the 1031, we actually really love the 1031. Our company is called Capital Gains Tax Solutions, and we think it has a great role in tax deferral and maintaining and building wealth, especially through cash flow real estate. But some of the challenges have to do with just the timing, which everyone knows about, like the 45-180 sprint that I call it. And it's tough. It's tough to find deals in a marketplace where it's either a seller's market or low inventory, which is exactly what we're facing right now. So the 1031 has the 45-180 challenge of timing, right? You have to identify the three. Typically, that's where most folks use the three versus the 200% rule. Then you have to close on one, two, or those three, equal or greater value within 180 days. And so that creates a sense of pressure, and also it can create a sense of having to purchase something that otherwise you would not have purchased if it hadn't been for the 37% of your gain or so. Depreciation recapture can be up to 45%. The second part about the 1031, that's a tough part, depending on what state you're in, of course. State and federal tax are a little bit different in every state, and I'm mainly speaking of California, but it's usually between about 30 to 45% with depreciation recapture cost of your gain. So the second thing is the depreciation schedule travels, and that's a big challenge because if you own real estate for a long period of time and you've done multiple 1031 exchanges, your depreciation eventually will go to zero. The only way to increase that depreciation is to buy a bigger property and take on potentially more debt and to get more depreciation. It's also not so favorable because depreciation is one of the number one reasons to own real estate, and that's what separates itself from almost every other asset class that's out there because you can offset the income that you're bringing in. And the third most challenging thing, we call it the candle burning at both ends. If you imagine a candle and it has a fire on both ends and it's burning and getting smaller, and this candle represents your return. As each end of the candle burns, your return gets smaller. And what's causing these candles to burn? Well, the first end is low inventory and increasing prices. And the second part of the candle is increasing interest rates. And so if we sell today in a seller's market, likely in 180 days, you're buying in a seller's market that's even higher. Also coupled with the interest rates have gone up. So your return gets smaller and smaller. So those are the kind of the three main challenges with the 1031 exchange. And again, we like it if you can find a deal, and we like it in either a buyer's market or more of a stable market, but a highly appreciating market, it can be a big challenge. The deferred sales trust, on the other hand, it's just an installment sale, and in fact, most of your listeners know this, seller carryback law. If I were to come to you, Simon, I want to buy a deal from you. Would you carry a note? Well, if you carry a note, for whatever amount you carry, you don't owe tax on that, and therefore the tax is deferred. And the deferred sales trust is just that. It's an installment note, but it's a manufactured installment note, which we add a third-party trustee, which is my company. And the unique part about it is once the funds are in the trust, once the transaction is closed, the buyer is gone, the funds can be invested back into commercial real estate at their own timing, or stocks, bonds, and mutual funds at their own timing, all tax deferred. So that's kind of a brief overview of the deferred sales trust.
So which point would you have to be responsible for the tax? When is that due? And maybe walk us through a little bit deeper into the mechanics.
Yes. So same thing with the 1031 exchange. When do you owe the tax for the 1031 exchange? Well, when you cash out or you receive the money, which is what we refer to as constructive receipt. That's what the IRS considers as well, constructive receipt. So when you see constructive receipt of the principal balance or any amount of the principal balance, the tax is considered due. So, for example, in a 1031 exchange, you buy a property, you send the money to escrow. From escrow, it goes to a 1031 QI. From the QI, it goes to the next property or the next LLC, which owns the next property, and so on and so on. It never goes to the owner's hands directly. And if it did, it's okay. Just they owe the tax, right? They owe that percentage of tax. That's what's known as boot. So the same concept is true here. When it's in the deferred sales trust, as long as it's invested and invest it into real estate or again, stocks, bonds, and mutual funds of the client's choosing, and they're just living off the interest, they're just paying ordinary income tax on that interest income. They're not paying capital gains tax because they haven't received constructive receipt of the principal balance. So the moment they cash out, which they can cash out and pay the tax. Most of our clients like to pay the tax. We call it the second day to never. So they're going to continue to defer, and they're typically 10-year notes. At the end of the 10 years, they can renew for another 10 years, and so on and so on. I can also pass on to their kids, and they can inherit their position as well. And so until anyone cashes out, the tax is not due.
Interesting. Okay, and unlike the 1031 exchange, which is like kind, deferred sales trust doesn't follow the same suit. Is that correct?
Correct. They're separate tax codes. So one is IRC 453, which again is just seller carryback or installment note, which came about in the 1920s, and the other one is the 1031 exchange, Section 1031, which came about in about the 80s. It was really made popular by the Starker exchange case, and which you mentioned is being some in Congress and some in Washington believe it shouldn't be there, and they threatened to take it away, and so that is certainly that certainly could happen with the new administration coming in. They could take it away. Where we're not that, we're an installment sale, and so they could take ours away too. Not to say that they could not, but we feel we're in a better position because there's this less percentage of installment sales that are going on. Versus the 1031, which is in commercial real estate, a large percentage.
So why don't we see more of the deferred sales trust happening in the business, or are we? We're just not hearing about it.
Yeah, well, let's talk a little bit about our track record. We've done over 2,000 trusts, and by we, I mean the estate planning team as a whole. It's about 1,100 professionals across the U.S. of financial advisors, real estate professionals, QI companies, insurance brokers, all with the sole focus of educating our clients as a team on the deferred sales trust. I think it's growing with the marketplace the way it is. The marketplace is such that we call it the perfect storm. And according to the American Bankers Association, about $17 trillion will pass from one generation to the next in the next 20 years, and this is known as the baby boomer population. And it's the largest amount of wealth transfer in the history of the world. And they're trying to figure out a way to pass on their wealth to their kids without getting hammered by that 33 to call it 50% capital gains tax and depreciation recapture cost. And they've made their wealth, and they've done very well, and they want to actually retire from their real estate, or at least simplify their portfolio. And they're actually tired of the 1031 or having to buy or having to purchase. So we're seeing this perfect storm with interest rates going up, with inventory going low, with values at 07 or even above 07 levels in some part of the country. so we're doing more and more transaction. I mean, our caseload is very, very large, and we're spreading the message. I think part of it too is the fact that we, unless you're working within the estate planning team, we have a proprietary structure. We have everyone sign a non-disclosure agreement. We don't mass market it because it is a specialized transaction that does take, tax attorney, CPA, real estate professional, trustee, financial advisor, everyone working together to provide this service. So I wouldn't say it's an easy transaction, and therefore it does take some education and some time. But we're doing a lot of deals, and until you meet us, I always say you don't know about it.
Yeah. No, that's great. And you mentioned or started getting into the whole team that you need to have in place. Can you elaborate on who's typically involved in these types of transactions?
Yeah, so what we do is we actually train real estate professionals, commercial real estate brokers. We say most real estate brokers have clients who struggle with capital gains tax when they sell their high-end primary homes or commercial real estate or a business. And we use this deferred sales trust to help them gain tax deferral, freedom, flexibility, liquidity, and diversification with their funds. So real estate brokers can add more value and earn more listings. So we usually start with the trusted advisor, whether it be a financial advisor, whether it be a business broker, whether it be a commercial real estate broker, or a high-end residential real estate broker. And from there, we educate them. And if you think about it, that's how the 1031 exchange message was spread. At a certain point, call it the 80s, 90s, not everyone knew about it, right? And then all of a sudden everyone does. And so it changed the way every commercial real estate broker approached every deal from there forward. And so we educate on the deferred sales trust, and we feel we're going to also change, and we are changing the way everyone approaches every deal because of these extra options. So we start with the trusted advisor, and we say, hey, look, we want to educate you on this. We actually think you already kind of know a lot of it because it's an installment note. We've been doing it for 22 years and closed over 2,000 trusts. We've also closed or survived or had no change audits on 14 IRS audits over those time periods too. So we really educate on our track record, on why it's legal, why it works, and then we say this might be a good solution for your clients because clients are facing, again, the baby boomers, and many of them want to be rid of the toilets, trash, and liability, rid of starting over with a new 1031 property with new trash, new liability, new management, new tenants, and they actually want to simplify their life and maybe diversify outside of real estate as well. So we start there, and then we say, hey, look, we want to bring in their CPA, their tax attorney, anyone else who wants to get educated, no problem. We all jump on a conference call, and we discuss the particular situation, the real estate professional, the financial advisor. If the client likes what they hear, they sign what's called a conditional engagement agreement, which simply means if they close the transaction, we all get paid. But they can decide they don't want to do it, no problem. We'll do all the tax legal work and education up until the 12th hour, and if they say no problem, they don't pay. So we educate, and then they can decide if they like to move forward. And then in the broker's eyes, hopefully they get a new listing or a new opportunity because they brought us a new solution to a client who was really looking for that. So we help them grow their business. And then from the client's perspective, they perhaps get what they want, diversification, liquidity, or just being rid of the management. The trustee, that's my role, and I'm the third-party unrelated trustee. Our company, Capital Gains Tax Solutions, is that. And what we provide is maintaining the integrity of the trust. So in order for this transaction to work, there must be a third-party unrelated trustee to help the client from having to take constructive receipt. And so we oversee the trust. Our role is to follow the guidelines based upon the client's perspective and also their risk tolerance. They fill out a risk tolerance questionnaire before the money goes anywhere. The last party is a financial advisor, and the financial advisor manages the money. They can have their own personal financial advisor, or we have our own that we can recommend, and they manage the money, and based upon, again, the risk tolerance of the client, and that's it. It's an installment note. They get the payments out, and they live off the interest for as long as they want.
Interesting. Can you give us an example or a hypothetical of how this has occurred for your clients?
Yes, I'll give you a real one that happened about a year and a half ago. There was a couple who needed to sell their really high-end home in Southern California, and they were selling it for $26 million, and there was their primary residence. And the government is so kind to give us the $500,000 exclusion if you're married. It's $250,000 if you're single, if you lived there 2 of the last 5 years. However, the property had appreciated in such great amounts over the years that they owed an additional $6 million in capital gains tax. And so what were their options? Well, since it was a primary home, they could not do a 1031 exchange. Right, and since their 500 exclusion was exhausted, they still owed this $6 million. So the unique part of the deferred sales trust is we're a perfect fit for these clients because we help them defer all $6 million. So they sold their home, and instead of paying the $6 million to the IRS, they moved all of the funds into the deferred sales trust, and that $6 million is now deferred, earning interest into stocks, bonds, and mutual funds. And at any point, if they find a real estate deal, they can direct those funds, all tax deferred, into another commercial real estate deal, or again, just live off the interest that is producing in the current portfolio that they have. So that's one of them. We've also done commercial real estate deals, apartment buildings, over $30 million. Our largest transaction is $126 million. We've done car dealerships. One recent one was an $80 million car dealership in California. And so it works for businesses, commercial real estate, primary homes, and just as a reminder to your listeners, only one of those 3 options, business, commercial real estate, primary homes, qualifies for a 1031, and that's commercial real estate. But a primary home and a business does not. So as a real estate broker, if you can walk into with a client and add value for if they're selling their business, and help them defer the tax, or selling their primary home and help them defer the tax, they can immediately redeploy back into real estate, and you as a broker can represent them on the buy side on that deal too. So it's a way to grow your business and add more value to your clients on all 3 of those asset classes, which, by the way, according to just the stats that are out there, I think this is another large bank who did this study, 50% of all of America's net worth is tied to high-end primary homes, commercial real estate, and private equity, which are like businesses. That's 50% of America's wealth, and those are all illiquid assets. And again, these illiquid assets, a lot of them want to get liquidity and diversification, and or just be able to time when they buy. Because as real estate professionals, we have a pretty good sense of it's a seller's market or a buyer's market. They're pretty clear in our mind of what it is. And again, if we can sell high and buy back into real estate at our own timing, that's a great advantage for everybody.
Mm-hmm. And that's what this gives you. This gives you that flexibility that you may not be able to have, or give you an alternative to what a lot of folks might be used to in the exchange world. So it's all about passing along the message and educating our listeners, which some may know about it, some may not, and giving them the ability to offer their clients an alternative or another option.
Precisely. And to that point, it can also save a failed 1031 exchange. So we've had clients who call us on day 170 saying, my 3 properties didn't work out. What do I do? And we just have the QI company send the funds to the trust. So we can save a failed 1031 exchange, which is big, right? It gives the client the power to go out and negotiate even maybe a little bit stronger on their behalf. It gives them a backup plan in case the deal doesn't work out. And it gives them leverage to negotiate, which is huge. So the other one is partnership interest. So if we have any syndicators on this call or listeners that are listening in on the podcast, we can help syndicators sever the partnership and have everyone defer the tax. So let's imagine, Simon, you and I and 10 others owned a big apartment complex, and we've owned it for 20 years, and we've all had a big gain on it. Most syndicators, or a lot of them, will not do a 1031 exchange because not every investor wants to go along in the next deal. They want their money. So oftentimes they'll just say, okay, pay everyone else their money and have everyone pay their tax, and let's all go do the next one. The unique part about the deferred sales trust is we can do an individual deferred sales trust for everybody, or for half the people, or a third of the people, whoever wants to have their own. And instead of the syndicator having the funds sent directly to the clients, they send them to their individual trusts, which are severed from everyone else, and they all defer their tax. And then they can redeploy the capital back into the next deal. So the syndicator not only has their clients that are a little bit happier because they have a higher return because they don't have to pay the capital gains tax, but two, he or she doesn't have to raise any more money or as much money as he would have if that same client base had paid the tax. And hopefully he has more referrals because they're happy. And the last one I'll share here is the estate tax. So for any high net worth clients or individuals out there, they have what's known as a death tax. Anything above $22 million, if you're a married couple, is taxed at 40%. This is above and beyond the capital gains tax. If it's inside of your taxable estate and it passes to your heirs. If you're single, it's $11 million is the highest exemption. So, for example, if somebody is worth around $50 million and they're married and all $50 million is inside of their taxable estate, if they sell or if they pass away and pass all of that $50 million to their heirs, $22 million was exempt, so that's fine. The kids can inherit that basically tax-free in the sense of no death tax. But $28 million of that would be taxed at 40%. So the unique part about the deferred sales trust is if they sell before they pass it on to their heirs or before they pass away, we can move all of those funds outside of the taxable estate, which in essence saves their heirs that 40% death tax. So that's a really, really big one. As a live example, I'm working with a gentleman right now who has about 19 apartment complexes across California, and they're worth about $1 billion total for those 19. He's wanting to sell and move outside of the taxable estate to save his son basically 40% on $978 million. Now, a lot of these high net worth folks have done estate planning, have moved some parts of their estate outside of their taxable estate, but typically it's a slow process and it's a gifting process that takes time, and it's also smaller amounts. Where with the deferred sales trust, any asset that sells that amount, we move that asset outside of the taxable estate. So he's selling a $40 million deal. And that's exactly what he wants to do. He's having his tax attorneys, everyone review everything, of course, and get their blessing. But he said, hey, if this works, I want to sell everything in the next 10 years, and I want to be able to move it outside of my taxable estate so that he can save his son 40% on that $978 million. I know that was a mouthful there, but essentially save your kids the 40% estate tax.
Yeah, that's amazing. And again, it's a strategy that gives them, I like to go back to it, but it's the option to defer and pass along that wealth, as you kind of alluded to earlier in the podcast. The ability that a lot of this wealth from the baby boomers is going to be transferred, and how best to transfer it is through the deferred sales trust. So,
correct. We think so. We think precisely right. Because at 1031, although you're deferring the capital gains tax, you're not moving it outside the taxable estate, right? So for the ultra high net worth, it's even extra advantage. Plus the depreciation reset. Remember, if you buy the deferred sales trust, you get a brand new depreciation schedule. I'm not sure if I mentioned that before. Whereas in the 1031, it's traveling. So any brokers who have clients who own properties for 30, 40 years and they just have never sold, part of why they've never sold is because their property tax is so low, and they don't want to reset that. The second reason is they don't want to chase the 1031. But the one compelling reason we found is the depreciation ROI. So what if we were able to reset your depreciation, and you could do a cost segregation and accelerate this new property you purchase? How would that look on your whole portfolio? So this is kind of like DST 2.0, because I know you have a sophisticated crowd here of commercial real estate brokers and owners. So that's the extra layer there of running multiple ROIs, not just on capital gains tax or property tax, but on depreciation recapture or depreciation schedule resetting, and then offsetting it with additional cost segregation.
Yeah, and I think that's where it's an important point that you now go from a real estate professional to now a trusted advisor, giving them more ability to look beyond just their real estate holdings, and as you mentioned too, how this applies to personal assets. And I think the list goes on on what you can utilize the deferred sales trust for.
100%. How are you adding value, right? The first thing I learned when I started my career is the moment you start adding value or more value to your clients and they know themselves, that's the moment you start growing your business. And so how are you differentiating yourself? If everyone knows the 1031 and 1031 is a challenge, how are you going to go outside of that and educate someone on something else that they may not know about and connect the dots to how that might help their situation out?
Perfect. Well, this is all great stuff, Brett, but unfortunately we are out of time. I do want to thank you for sharing the information and opening me up and hopefully our listeners to what is an alternative out there. And how do folks get a hold of you if they have further questions or want to discuss this further?
Yes, so a couple of ways. You can go to my website, capitalgainstaxsolutions.com, all one word, capitalgainstaxsolutions.com. We're on Facebook, we're on LinkedIn. You can also email us directly at info@capitalgainstaxsolutions.com. That's info@capitalgainstaxsolutions.com. And we can set up. We also have an online calculator, which is unique too, where you can enter in your information or the particular property's information or business you're selling, and it'll give a side-by-side comparison of pay the tax versus do a deferred sales trust. And then we also have webinars every Friday at 10 a.m. where we will walk through the deferred sales trust, how it works, and you can see it visually and answer questions. Everyone's invited. It's no cost. Just have to send us an email that you'd like to attend, and we will send you the link out.
Awesome, Brett. Well, I appreciate it, and thank you again. If any of our listeners also want to learn more about NAI Global, please email us at help@naiglobal.com or call us at 609-945-4047. Thank you for listening.